Thank you very much for taking the time to listen to our presentation. I'm also joined by Louise George, who at the minute she looks invisible, but she will become visible during the Q&A session, and we'll do the Q&A at the end together. Please feel free to ask questions about anything. We do engage with retail investors on a regular basis. We joined a seminar earlier this week. We always respond to emails, questions sent to us via investor relations, and we do have a pretty strong sort of loyal following of retail investors. So please feel free to ask any questions about anything at all. The slide deck is available to you, and although I intend to run through sort of 5 or 6 slides max, there is quite a heavy sort of slide deck that you have access to. And please do make the best use of that. It's full of appendices and useful information about the business and the general property markets. Just before I run through the presentation proper, just a few useful points for you. Our ticker is BLV. We floated back in 2012, and I've been with the business for the last 16 years. This is my 17th year. We floated with a share price of 75p. And a market cap back in 2012 of 16 million. The market cap today is 95 million. Share price today is 262.5, which is 60% higher than it was 12 months ago. We're profitable, and we always have been. We pay a dividend, and we have, based on our H1 results, and we announced a few days ago that we're increasing our dividend by 17.6% from 3.4p. This is the interim dividend, from 3.4p to 4 pence a share. The ex-dividend date, for anyone who's interested, is the 16th of September. Our turnover this year is will be 25 to 30 million. We are profitable, as I say, and we've always been profitable since we listed on AIM. Our PBT in the first half of this year is 4.8 million, and I'll run through some sort of numbers for you shortly. Our profit before tax has increased by 51% on H1 2020 versus, H1 this year versus 2020. Interestingly, we did have, dare I say it, a good year last year. We finished the year exceeding market expectations, which we're very pleased about, and I'll sort of explain some of the mechanics around that shortly. We operate in 3 markets. The 3 markets we operate in are mortgages, consumer mortgages, property management, so where we look after properties for landlords, and we also operate in the estate agency sector. We are a franchise business. Rightio, so that was the introduction sort of slides done. So who are we and what do we do? Well, first and foremost, we're a multi-brand property franchise group across 460 offices nationwide. I said earlier that we operate in 3 key markets, so property sales, property lettings for residential landlords, so looking after tenancies, letting properties for landlords, and we have fairly recently entered into the mortgage market, and from a standing start in 2017 we've built a mortgage business that now consists of 242 mortgage advisors. We represent 15% of Mortgage Advice Bureau's advisor base, and some of you may be invested in Mortgage Advice Bureau. So just an explanation for you on the brands that you can see on the screen. So when we first listed on AIM, we listed as just Belvoir, so we were a residential letting specialist. We had no involvement in estate agency or mortgages, and we'd sort of grown a network of very successful franchisees working from, so these franchisees work from shops. We help them to grow their business. We provide website services, support, training, compliance, a whole raft of services, as well as brand and marketing for our franchisees. So we first grew Belvoir as a brand, floated in 2012, and in 2015 we embarked on what we call a multi-brand strategy. So we first acquired Newton Fallowell in 2015. So just jumping back to sort of Belvoir and Northwood, I'll cover now. So we've got 366 lettings and estate agency franchises. On the right-hand side of the screen, we've also got 101 mortgage advisor offices. These are generally retail units. Some of them are small commercial units that you can sort of walk into and talk to the teams in these businesses. Across the property division, 366 lettings and estate agency franchises. Belvoir and Northwood form the lion's share of our lettings and estate agency network. Across Belvoir and Northwood, 90% of franchisees' revenue comes from residential lettings, so it's very strong recurring revenue, which has always been probably the most attractive. Second to franchising, that's probably been the strongest reason why investors have sort of joined us over the years. So we're underpinned by recurring revenue, and I'll illustrate how robust that revenue is. So during the first lockdown last year, we were instructed to close our offices in lockdown 1. We weren't expected to close in the second and third lockdowns, just the first one. So we closed our doors for 2 months. Belvoir and Northwood franchisees retained 90% of their revenue, even with their doors closed. So tenants continued to pay their rents. We continued to provide maintenance and support services for landlords, and our revenue was protected. Hence, we had the outcome of last year was that we sort of exceeded market expectations in the full year. So Belvoir and Northwood, very much lettings orientated franchises. Newton Fallowell and Lavelle, I do appreciate if you haven't been to the East Midlands or Lincolnshire, you may never have heard of Newton Fallowell or Lavelle. They are very strong estate agency brands in the East Midlands and Lincolnshire. They're performing very well at the minute, as you might expect. We acquired Lavelle at the beginning of last year, which I must admit the timing probably couldn't have been worse actually in terms of completing on a deal a few weeks before lockdown. However, with the upturn in the property sales market, i.e. pent-up demand, lots of people looking to move house, the race for space, as well as the stamp duty holiday that was announced, we're very pleased to have had Lavelle because the business really did take an upturn in the second half of the year. Earlier this year, we acquired another franchise brand, Nicholas Humphreys. This brand is different to Belvoir, Newton Fallowell, Northwood and Lavelle in that it's a student lettings business. So if you've had any experience of student lettings, either from a tenant or a landlord's point of view, it can be very lucrative for a landlord in student lettings. It's a different regulatory framework, so a lot of the properties in the student sector are housed of multiple occupancy, so it's just different. But we do have student experience. We've acquired 20 more franchises, and we plan to continue the rollout of Humphreys on a longer term basis. The next brand at the bottom is Nottingham Building Society, an unusual arrangement in that firstly we occupy 39 of the Nottingham Building Society's offices on a concession basis. That's window space, desk space and somebody in their office to really to facilitate property transactions. We then feed a referral fee back to the Nottingham. On top of that, we acquired the Nottingham Building Society's mortgage business a few weeks ago, and if you've been watching our RNSs, you will have seen this unfold. So we brought on another 21 mortgage advisors, and we now write all of the mortgages on behalf of Nottingham Building Society. The third sort of aspect to the Nottingham is that this doesn't start until Q4 this year, but the Nottingham, in partnership with Mortgage Advice Bureau and us, are launching an app called the Beehive Money app. This app is aimed at the 50,000 LISA savers that the Nottingham Building Society currently has. They're looking to increase that number from 50,000 to 100,000 LISA savers. We have exclusive access to those savers to sell them mortgages, products, services and property ultimately. So it's a unique arrangement, something that's brand new. It looks like a small acquisition, but it's got real depth to this arrangement. So this is unique in our sector. On the right hand side of the screen, financial services. We've grown a very effective financial services business. We've chosen to contract with Mortgage Advice Bureau. So the advisors are our advisors. They're either on our payroll or they're self-employed to us, but we choose to contract our business through Mortgage Advice Bureau. So we are MAB's largest client. So that's just an introduction to the business itself. Now I'll run through just a few key highlights of the sort of H1. Revenue up 41% in H1 this year to 13.8 million. MSF, which is our management service fee, that's the fee franchisees pay us for supporting them, up 26%. I've mentioned that we put the dividend up by 17.6%, which has gone down very well with our investors. Mortgages, we arranged 8,300 in the first half of this year. It's likely that we'll arrange between 17 and 18,000 mortgages this year. And as I say, this is a relatively new business for us that's going very well. Profit before tax up 51% to 4.8 million in the half year. EPS 9.9p, which is up 36% on this time last year. EPS, interestingly, if you've been tracking us, is up 165% over the last 5 years. House sales, which has been very buoyant because of market conditions. House sales actually is a relatively small part of our business. So in a normal year, if you split out financial services and just look at our property business, 80% of our revenue normally comes from residential lettings, from managing properties, and 20% comes from estate agency. So that mix has changed to 73-27 because of the upturn in estate agency. But the upturn will sort of pair back to a normal trading sort of environment where estate agencies are a smaller part of our business compared with lettings and mortgages. And I've mentioned the growth in financial advisors, which is on the screen. So just a few sort of points to wrap up before we move into the Q&A. Why invest in Belvoir? Well, if you're interested in franchising is such a wonderful business model, but when it's done well, it works really, really well for the franchisor, and it works really, really well for the franchisee. That's when it's done well. We've been in franchising for 25 years. I've been with the business for 17 of those. We're operating through 6 brands at the minute. We are looking to expand our brand product set into the in the near future. If we're operating 6, there's nothing stopping us from operating 16. We've got a history of strong financial growth. We've had 24 years of unbroken profit growth with, as I say, EPS up 165% in 4 years. We've got a long-serving, very well-established management team. The manager of Belvoir, the managing director, the guy who runs Belvoir, has been with me for 15 years. The gentleman who built Newton Fallowell, Mark Newton, sits on our board. The lady who grew Brook Financial, which is the mortgage side of the business, she runs our FS side. So we've got a very long-standing management team. High degree of recurring revenue, which is actually lower than normal because we've done more estate agency. So it's 56% of our revenue is recurring, of our gross profit is recurring, and that comes from residential lettings mainly. That will sort of tick up to about 60% as estate agency falls back a touch. We've successfully diversified, as I've explained, on the mortgage side. From a standing start in 2017 to become Mortgage Advice Bureau's sort of largest account is a key achievement. We're very ambitious on the mortgage side. We feel we can take the growth of that business much further. And we've had a very successful acquisition strategy. We've assimilated 5 franchise brands into our business and 3 financial services businesses into our stable of brands since 2015. And on top of that, we've helped our franchisees to acquire 105 of their competing businesses, and then we benefit from the repetitive MSF that comes from those acquisitions. So that's just I do appreciate it's a whistle-stop tour through the business. We do operate in most parts of the UK, in Ireland, Scotland, Wales, throughout England. The different coloured blobs, which will be bigger if you download the presentation, just show where the brands operate. Where I'm sitting right at this minute is in Lincoln, and we've got all 6 of our brands operating in Lincoln, as well as mortgage advisors. But to summarise, we've had very strong trading across all 3 of our markets. The current pipeline of house sales and mortgages, current today, is 70% bigger than it was in August 2019, which means that Q4 this year is pretty safe for us, and we are confident that we will achieve market expectations this year. We've been confident about that for some time. So more acquisitions to come, more development of the financial services business, and more development of the property division, which we have been very successful at growing this network over the last 7 years.
What impact will increasing rental rates have on lets at Belvoir?
Yep. So increasing rental rates, if you're tracking rental inflation, when I reported to investors back in April, I said that rents were going up everywhere apart from in London because we've had a behavioural change, less travellers, less people working in London. That trend has now reversed, so we're seeing positive rental growth everywhere. At the point a new tenancy is created, this has been covered by the media actually today, in that rental growth is the strongest it's been for the last decade. That was reported on today in the press. At the point of creating a new tenancy, we're seeing rental inflation in the southwest at sort of 11.9%. We're seeing Lincolnshire, East Midlands, at sort of 10.5%. London sort of 3.5%. Interestingly, most of our business isn't in London. I'll just point that out. I know we've got the map on the screen. So 93% of our revenue is from outside of the M25. We're not a London-based agency chain, which in some years that's a weakness. In other years that's a strength. It just depends how you look at it. But the bottom line is that's a benefit for our agents and it's a benefit for landlords. I'm not sure that sort of really aggressive rental growth is great for the sector long term. However, one of the reasons for this is not just COVID and it's not just pent-up demand and it's not just because house prices have gone up. Over a 5-year period, there have been a number of disincentives, tax disincentives that have discouraged landlords from joining the sector. So what hasn't happened is landlords haven't exited. So over the last 5 years, the percentage of properties that are privately rented has been at 19% of housing stock, and it's been the same for 4 years. But fewer landlords have joined the sector. During the same period, 1 million new dwellings have been created under home ownership. So the government's method has worked. The buy-to-let's been calmed down, home ownership has increased. But now what we're seeing is just a shortage of rental stock, which, if government doesn't do something about that, tenants are in line for fairly heavy rent rises over the next few years. And, that's not down to the landlord or agent. These are market conditions.
Okay, thanks, Dorian. Which leads me on to the next question, actually. Property business went from 80-20 revenue split, letting to property sales, to 73-27 this year, thanks to recovery in house and flat sales. What is the optimal sustainable split? Could it be 70-30 or 60-40? Question mark.
That's a really good question in a nice way. But interesting, for as long as I can remember, Chris, I've said to investors that our revenue split is 80-20, and honestly, this goes back for 6 or 7 or 8 years. It's only this year where the mix has changed significantly. It's only changed by a few percent. As you rightly say, it's now sort of 73-27. I think that will fall. I think that will return back to 80-20 over the next 6 to 12 months. So I don't see that continuing. We are actually a residential management business at the heart of us. We're a franchise firm. We're residential property managers. We're very good at it. We manage 71,500 units. And we can see expansion in the private rental sector. We want to get more involved in block management in the future. PRS is sort of being talked about. So we've got strength in every part of our business, and every part of our business is growing. We're not reliant on purely sort of property sales or lettings. We're not reliant on anything.
Okay, thank you. Why do you think the share price has become more volatile recently?
Yeah, again, another good question. We had we had 2 people ask us whether it was because we'd exercised share options and because the share price sort of about 10 days ago started to move down slightly. But you've got to bear in mind that the share price is 60% higher than it was 12 months ago. So that's the sort of the backdrop of the share price sort of movement. It was nothing to do with our share options because we didn't agree to exercise our options until Monday morning. So unless somebody had a serious crystal ball, it was impossible to have been connected to that. And on top of that, we don't exercise options very often. It's the 3rd time I ever have exercised any options. The first time was sort of last year, and my options were about to expire, so I just had to, exercise them. We're in this for the long term. We've both increased our holdings. We don't have founder wealth, so we always have to sell to pay our tax bill, unfortunately, but that's just, such is life. But, our wealth and our future is invested in this business the same as our shareholders.
And what does the share register look like in terms of split, institutional to retail?
Louise, do you have those sort of figures to hand? by any chance?
No,
We
I
can
don't.
take, if not, we can take it back.
Yeah, we can take it offline and answer it through your other channel. But I suspect it's sort of 80 or 90% institutions.
But you know the value and the importance, and obviously that's why you're here tonight, speaking to retail.
Mm.
Yeah, we've got some really good sort of retail, or really what we think is quite a good and growing retail following. We've attended a number of events, Chris. We only started sort of engaging more heavily with retail investors, private investors about 2 years ago, and we maintained some really good dialogues with sort of small groups, investors and individuals.